Dear student, Assalamu alaikum. I hope by the grace of Almighty Allah, all of you are fine. Dear student, I am Mohammad Shahjahan, Assistant Professor, Department of Accounting, Milestone College, Uttara, Dhaka. Dear student, today we will discuss chapter 10 and this is Introduction to Management Accounting. Dear student, the topics will be CVP analysis. CVP means volume profit analysis. Dear student, this is our first lecture on this chapter. Dear student, after this lecture, you can able to know about cost volume profit analysis. You can about types of cost. You can know about the break-even point. You can know about necessary formula from CVP analysis. Dear student, now what is cost volume profit analysis? Dear student, cost volume profit analysis is used to determine how changes in cost and volume affect a company operating income and net income. Dear student, in performing this analysis, there are several assumptions made, including sales price per unit is constant, variable cost per unit are constant, total fixed cost are constant. Dear student, that means there will be some assumption for this analysis, and after this cost volume profit analysis used for taking decision. That means, dear student, it is a part of management accounting. Management will use this type of accounting for find the performance of cost volume profit. That means find the performance of profit with the volume of cost. Dear student, let's come to our class. Dear student, types of cost according to its behavior. Dear student, this is very important topics for this chapter. Earlier I have told you that this chapter we will discuss cost volume profit. That means cost is the main element for find out the profit. Dear student, there are three types of cost mainly according to its behavior. Dear student, in other chapter we have learned different types of cost. Here we will learn that according to its behavior, cost is three types. Number one, it is fixed cost, then variable cost, then mixed cost. Dear student, what is fixed cost? Dear student, a fixed cost is an expenses that does not change as production volume increase or decrease with a relevant range. Dear student, that means fixed cost means this type of cost will be fixed. It will not be changed. It is fixed for the organization, fixed for a certain amount of production. That's why it is relevant range. That means if you increase the volume of production unlimitedly, that time may fixed cost change. That's why it is called that fixed cost is an expenses that does not change of production of volume increases or decrease with a relevant range. Dear student, in other word, fixed costs are locked in place as long as operation stay within a certain size. That means fixed costs are locked. It is not changed. It is fixed, locked in place as long as operation stay within a certain size. For total production, fixed cost is fixed, but for per unit production, fixed cost is variable. Dear student, this is important MCQ for your exam. The total fixed cost is fixed, but for per unit production, it is variable. Look at it by an example. In an organization, fixed cost is 10,000 taka and production is 2,000 unit. Here, fixed cost per unit is 10,000 divided by 2,000. That means taka 5 per unit. But if production is 2,500 unit, that time fixed cost will be taka 4 per unit. That means it varies. When production unit changes, fixed cost will not be fixed. Fixed cost varies, but in total it will be always 10,000. If there is if it is 5,000 production unit, then it will be taka 2 per unit. If it is 1,000, then taka 10 per unit. That means if production volume is changing, then fixed cost also will be changed per unit, but in total it is 10,000. That's why it is called fixed cost. Dear student, I hope you understand. Now, variable cost. Variable costs are costs that vary with output. That means for every unit, variable cost increase or decrease, changing. Generally, variable cost increase at a constant rate relative to labor and capital. Variable cost may include wages, utilities, material used in production, etc. Variable cost per unit is fixed, but in total it is variable. Dear student, the just opposite of fixed cost. In fixed cost, it is fixed in total, and variable cost in total it is variable, but per unit it is fixed. That means per unit always same amount. For example, dear student, in an organization, variable cost per unit is taka 5. If that organization produce 2000 unit, then total variable cost is 10,000. Total variable cost is 10,000. Dear student, if you produce 1 unit, variable cost will be only taka 5. But if you produce 10,000 unit, variable cost will be 10,000 into 5, 50,000. If you produce 2,000 unit, 2,000 into 5, it is 10,000. That means it varies with the level of production. On the other hand, if production is 2,500 unit, then variable cost will be 2,500 into 5, it is 12,500. That means per unit it is fixed, but in total it is changing. I hope you understand. Dear student, now mixed cost. In accounting, the term mixed cost refers to cost and expenses that consist of two components, a fixed component, a variable component. That means it is a cost where some element are fixed, some element are variable. That's why it is mixed cost. Another name of this cost is semi-variable cost. Semi-variable cost, like for example, I can say you electricity bill. Dear student, if you see the electricity bill of your house also, there are some line rent fixed amount. It may be like 100, and rest of the amount, how much unit you uses for that, that is variable. If you use 1 unit, it may be like 6. If you use 2 unit, it may be 6 into 2. It is 12. But fixed one is always fixed. That's why electricity bill is an example of semi-variable, that means mixed cost. I hope you understand. Dear student, now another important topics for CVP analysis. It is break-even point analysis. Dear student, break-even point is a term in accounting that refers to the situation where companies' revenues and expenses are equal. That means in break-even point, whatever the expenses, they earn same amount of money. That means there is no profit, there is no loss in this level. That means the company is in break even. Dear student, most of the company at the beginning, they would like to cover the break-even point only. Their student, at this level of sales, the organization have no profit or loss. An important objective of business is to at least break even, although making a profit is even more desirable. But if they can cover the break even at the beginning of business, that means they can earn profit in future. The break even point is calculated by dividing fixed cost by the contribution of our unit. Dear student, inshallah, in next class we will discuss how you can find out the contribution. Dear student, this is a chart of break even point. Look at the figure. In here we show unit, and in this axis we show taka. Dear student, then this is a line of fixed cost, this is a line of fixed cost, and then variable cost. Fixed cost, look at fixed, and variable cost, it is increasing, it is increasing, it is increasing. Then this is sales line, revenue, sales line. Look at here in this point, the total cost, fixed cost plus variable cost, total cost, and the sales are in same point. That's why this point is known as break even point. This point is known as break even point. Dear student, inshallah, next class we will discuss more about this. And now some important formula. Dear student, just you will copy this formula, and the colored one is important formula. Dear student, you will write it in the homework, learn and write the important formula, and next class we will do the math. Dear student, I hope all of you stay home, all of you stay at home and stay safe. May Allah